So my talk is about relative valuation in the financial sector. I'm going to talk a little bit about price multiples and conditional price multiples, two approaches for relative valuation. And I'm going to discuss results from 3 studies. One co-authored with Charlie Calaveras about the banking industry, another one on insurance companies, and one that looks on relative valuation, looks at relative valuation in general in the financial sector, the different industries. So I will try to make this presentation as practical as possible. So I will talk about some results from academic research, but I try to make the takeaways more practical. Price multiples. We value a company by taking a fundamental of that company, such as earnings per share, book value per share, or tangible book value per share applied in the financial sector. Outside the financial sector, we also look at things such as EBITDA, revenue, capital. We take that fundamental for the company and we multiply it by a multiple. The multiple is calculated by looking at the average relationship between that price and fundamental across a group of comparable companies. So we make some assumptions when we implement price multiple valuation. We assume that there is proportionality between the value and the fundamental. So if you increase the fundamental by 10%, value should go up by 10%. Strong assumption. We also assume that similar proportionality, the same multiple, applies to all the companies, all the peer companies that we use when we calculate the average multiple. And that we are assuming also that the price, at least on average, the price of these comparable companies is correct, at least on average, so that we can apply the multiple to the fundamental and get a measure of intrinsic value. Okay, so strong assumptions. But we still know that this approach is used a lot in practice because it's easy to implement, it uses market information directly, and we value a company relative to peers. And when we properly implement this, we get reasonable valuation. So it's used a lot as a standard valuation, primarily by sell-side analysts. When we do some of the parts valuation, it's almost always that we use multiples, price multiples. When we value components such as investment in associates, or when we decide how much of the value of equity to allocate to non-controlling interest, again, we use this approach. Terminal value calculation, either as an exit multiple or the terminal value, or as a check on the Gordon type calculation. And we also use it sometimes to reverse engineer what price is basically telling us about the cost of capital, or about expected profitability or expected growth. And this will tend to be more done in academic research than in practice. There are important disadvantages for price multiples. The relationship between the value and the fundamental is not linear. Much more than one fundamental matters for price. We can only implement this approach when the fundamental is positive, because if it's negative, you get a negative value. Finding comparables is very difficult. And we know that when we measure the multiple, it may be imprecise, either because of estimation error or because the market pricing may not be efficient. We can address some of these issues by making sure that we select and measure the fundamental and the value correctly, or to the best that we can, when we select fields and when we measure the multiples. These are not independent choices. So I'm starting to focus on the financial sector. We know in the financial sector, the price multiples that are used most are price earnings, price to book even more so, price to tangible book value being the book value of equity minus the book value of tangible assets, goodwill and other intangible assets. And we typically do it at the per share level, unlike EBITDA multiple or revenue multiple, which would tend to be more at the entity level. So if we want to get reasonable estimates of value from implementing price multiple valuation, we have to think about the following issues. We know that price reflects information or intrinsic value should depend on what future earnings are expected to be. So if we want the valuation to work properly, we want the fundamental to be strongly related to future earnings. So for this reason, we typically, if you look at earnings or other flow measures, we tend to remove special items from the earnings construct to make it more likely, a measure that is more likely to persist in the future. We try to address some accounting distortions. Many times we use forecast, typically we use forecast, not actuals, because we say with forecast, analysts don't forecast special items, so it's good. And also forecasts reflect more information than just what we have in the reported earnings number. And if we do use actuals, we prefer to use the most timely information that we can get, trailing 4 quarters or trailing 12 months. There are also some additional adjustments we have to worry about that we will come back to. So basically what I did in this study, the first study, the one looking at the insurance industry, so I looked at all insurance companies in the US over the last 20 years or so, at least at the time of the study, the last 20 years. And I implemented fundamental about price multiple valuation, using income before extraordinary items as the fundamental, and then trying to test whether indeed in this industry, the insurance industry, when you remove special items from earnings, you do get more precise valuation. So what I did was, for each company, so we talk about the insurance industry. The insurance industry is 5 sub-industries: property casualty, life and health, multi-line, reinsurers, and brokers. So for each of these sub-industries, I selected one company each month. Each month I conducted this, selected one company, then calculate the multiple for that company as the average. The harmonic mean is the average measure that I use. We'll talk about that on. The average across the remaining companies in that sub-industry. Then apply the multiple when I used income before extraordinary items to income before extraordinary items. When I use income before extraordinary special items to that measure. Then I compare the estimated value with the price, and I ask the estimated value, how far is it from the price? Is it within 10%, 25% of price, and so on? And then I ask, when I use this fundamental, what percentage of the time do I get an intrinsic value or an estimate that is within 10% of price? When I use this measure versus when I use this measure. So we see that this measure is better because it's more likely to give you a measure that is close to price. Okay? And you can see this is the pool over the 20 years. When we look at 10% for price, 25% of price, and so on. And this is showing the results over time, so you can see changes over time, focusing basically on this bucket. Okay? So the result as expected for this one excludes special items, and you get more precise valuation if you believe that price is efficient. Okay? Now, getting more specifically to the insurance industry. If you look at the income statement of insurance companies, the revenue section of the income statement typically includes 4 items, 4 sources of revenue. The premiums that they generate, the investment income, some fees that they generate, and then realized gains and losses. A significant item for insurance companies because they have large portfolios and they sell securities. These realized gains and losses that they report, net investment gains and losses that they report in the income statement, the magnitude of this item is quite large. By definition, gains and losses are supposed to be transitory, and also they are discretionary in the sense that if you don't sell the investment, you don't report them in your income statement. So analysts, when they want to come up with a measure of recurring income, so that it will be a better fundamental for price multiple valuation, they tend to exclude these net investment gains and losses, and they refer to this construct called net operating earnings, or operating income. And this is just one example, but you can see in analyst reports looking at this industry that that's what they typically do. So this didn't seem to be a significant research question to me because it's clear it should work. It should give you more precise valuation. Actually, it doesn't. Exactly the opposite. You exclude gains and losses, investment gains and losses, and you don't find improvement. In fact, sometimes you find that it actually makes the valuation less precise, not more precise. Very surprising result. Because again, theory tells you remove this item, it should be more persistent, and it's not. What is going on here? I think what is going on here is that insurance companies basically use this item to smooth income. So if you include this item, you get a measure, a better predictor of future earnings, because insurance companies basically make it a better predictor of future earnings by removing transitory items elsewhere in the income statement, the impact of those transitory items by realizing gains. This is typically what we have, but not during the financial crisis. During the financial crisis, they clearly used realized gains and losses, and this is a very significant difference to manipulate income. Okay? So while normally you do want to remove you don't want to remove realized gains and losses, in periods where you know that they are more likely to manipulate the numbers, you probably do want to. Okay, so this was one result, not expected result. Then when you compare actual earnings to forecasted earnings, clearly you get much better, much more precision. When we look at, so the next thing that I did is price versus earnings per share. If you have dilutive instruments, then price will be diluted. Investors will price this. So if you want to calculate a fundamental, that fundamental should be also on a diluted basis. Theory suggests so. Is it the case? The answer is yes. You do. If you use diluted earnings per share instead of earnings per share, basic earnings per share, you do get slightly better, more precise valuation. Not a big deal, but slightly more significant, especially when you look at the tails, when you look at the big valuation areas. This is not surprising because in this industry, we are less likely to have options and convertible that will have significant dilution effect. Some results for book value. We know that outside the financial sector, it's typically earnings, some construct of earnings or flow that we look at. But we know for financial service firms, book value plays a significant role, and there are important reasons for this. What we have on the balance sheet is typically measured at amounts close to fair value. Unrecognized intangibles, which make the book value less informative, are not that significant for financial firms. And then we know that the way that these guys are regulated, they are regulated first of all, financial firms, and the way that they are regulated basically makes the book value a proxy for earnings, because how much you can engage in activity depends on how much book value you have. And how much you engage in a given activity will determine how much earnings you will generate in the future. So there are good reasons to expect that book value multiple will work well in this industry. So I test this. I compare book value to earnings per share, and the answer for insurance companies, you know, in the past, earnings used to be better than book value. But over the last 10 years or so, this clearly reversed, and especially during the financial crisis. So book value is increasingly more relevant. And if we think why, we know there are several reasons for that. One reason is that we know earnings are becoming more and more volatile for economic reasons and for accounting reasons. And the more volatile the earnings are, the less useful they are as a predictor of future earnings, and therefore they don't perform that well in multiple valuation. And accounting-wise, we know there is a shift toward measuring more things at fair value on the balance sheet, and this makes book value a better proxy for future earnings. So this result, interesting, maybe not very surprising, but clearly an interesting one. What is interesting is that book value performs so good that it's actually, at least during the financial crisis, it performed as good as and even better than forecasted earnings. When we try to apply this logic of diluted versus basic, we don't see much improvement here. And the reason is that it's difficult to measure diluted outstanding shares. Companies don't disclose diluted outstanding shares. They disclose diluted average shares, not diluted outstanding shares at the end of the year. You can try to estimate this, and I tried to estimate this, but I didn't get much improvement. Then comes another question, very significant in the insurance industry. This concept of accumulate other comprehensive income. In the insurance industry, accumulate other comprehensive income in the insurance industry is related primarily to the marking-to-market of the investment portfolio. So life insurance companies will have 70% of their assets invested in securities, and they will mark the securities, they will classify them as available for sale more than 80% of the time, and mark to market, and then the unrealized gain or loss goes to accumulate other comprehensive income. So analysts that follow insurance companies say, we don't like this. We think that this marking to market of the investment induces volatility to the book value. That is not, they say there's two issues with this. First, it's very volatile, so it makes the book value very volatile, and therefore makes the book value less useful for valuation purposes and for measuring the return. This is one argument that they make. Another argument, a more sophisticated one, is the following. They say, look, we mark to market the investments, but we don't mark to market the reserves. So for example, if interest rates go up, the investment drop in value, and we recognize it in the book value. But we don't reduce the reserve, the insurance, so that the insurance will go down in value when interest rates go up. So we use market values for the asset side, and we use historical cost for the liability side. So we're basically inducing volatility that is not real volatility. So if we remove accumulate other comprehensive income from book value, it should make book value more useful for valuation, more useful for evaluating profitability, and more useful for valuation. And this is very common in this industry. These are just two examples from analyst report or from a company's report, but this is very common. And the argument, these arguments seem to make quite a lot of sense. The problem with these arguments is that one is that this issue of transitory items is not really that relevant because we don't use book value as a proxy or as a measure of recurring earnings. We use book value as a measure of capital. And when we have more capital, we should have more earnings, and it doesn't matter where this capital is coming from, whether it's because the value of the investment went up or because we put more money into it. So that's one problem with the argument. The other problem with the argument is that it's true that we mark to market the investment and we don't mark to market the reserves, but what drives changes in the reserve and what drives changes in the market value of the investments are not necessarily the same. Clearly, we saw this during the financial crisis. During the financial crisis, when credit spread changed a lot, they changed in a way that didn't necessarily, it was correlated with the liabilities versus the assets. So this argument of perfect correlation essentially between the asset and the liability is not there. This is the common practice. What they find is a very clear result. Don't do that. Because when you do that, consistently so, during the financial crisis, before the financial crisis, consistently over time, months after months, book value is better than book value excluding accumulated comprehensive income. So this result basically telling all these analysts, which you're doing, good arguments, but there are also arguments on the other side. Empirically, you should not do it. Okay, so this was one result. Let's see, times. Okay, so we talked about the fact that in this industry we look at primarily price earnings and price to book value. And we select these comparable companies. So basically we say, look, let's say we're working with earnings per share. So we take the earnings per share of the company and we're going to apply multiple, price earnings multiple, that we're going to calculate as the average across these pair companies. We're basically saying the same multiple that applies to the comparable should also apply to the company, the subject company that we're trying to value. For this to be the case, the comparable have to be similar to the subject company along these dimensions. Along risk, interest rates, if we are in the same economy, then the interest rate is the same, but the risk is different, earnings quality, economic growth prospects, payout. So you can think about, and now I'm talking not just about insurance companies, but in general in the financial sector, we can think about proxies for these things. For example, this would be proxies for risk, growth, payout. And we can basically ask which determinants, are most important. So if we're trying to select comparables for price multiple valuation, which one should we focus on? So when we think about PE ratio, we typically think about the growth. We think growth is the most important determinant. So if the comparables are expected to have much more growth or much less growth than the subject company, they should have a different multiple. Is this the case? Is growth the most important one? Well, I looked at the analyst long-term earnings growth forecast as a proxy for this, and then the other proxies that I used here. And the result actually, so I went through this exercise, I'm not going to get into the specifics of it, but basically what I find, if you look at the different types of industries in the financial sector, we don't find this result. We don't find that earnings growth is the most important determinant. It's not the one that will give you, if you select comparables based on the long-term growth, it's not necessarily going to make your valuation more precise. It's much more important to select based on size and based on payout and maybe based on stock return volatility. So this was quite surprising. I was expecting to see that the combined value would be the most important one and the other ones may play a role, but this would be the most important one. This is not the case. I did the same thing for price to book, which again is the even more important measure that we use. Here, we basically identify an additional determinant, which is ROE. And we know that people talk a lot about the relationship between price to book and ROE for financial firms. This is another variable. So I added this variable now, ROE, and I looked at what does it do to the price to book ratio. And the results here are actually very clear. Almost every industry, including this one, it's very significant. It's just not as significant as size. But if you think about it, reinsurance better be large. It's the most important thing for that. So it's actually not that surprising. But even for these guys, it's very significant. When you're doing price to book valuation, the most important determinant to look at when you select comparables is ROE. Much more important than any of the other determinants. So this, I think, was also another result with very practical implications. Okay. Let's give these results. I don't have much time, so we can go to I'll talk about my results in front of this chart. Let's talk a little bit about conditional price multiples. So price multiple, you basically take some fundamental and you multiply by the average multiple. Conditional price multiple is a bit more sophisticated. You basically say, instead of just averaging the ratio across the comparables, let's look at the relationship between the value ratio and relevant fundamentals. So for example, we just saw that the price to book, the most important determinant of the price to book is ROE. So if this is the case, instead of taking the average price to book across all the comparables, run a regression of the price to book on ROE, take the fitted value from that regression, the fitted value calculated with the ROE for the subject company, and apply the conditional multiple, conditional on the ROE of the company, apply it to the book value of the company, and this should give you a more precise value evaluation in the financial sector for at least two reasons. One is that financial sector is unique in the sense that in this sector, it's two fundamentals that matter a lot, book value and earnings. We saw that. Other sectors, earnings will typically be some construct of earnings will be the most important one. This is not the case for the financial sector. So in this sector, it's particularly important to be able to extract information both from the book value and from the earnings. So this is one advantage particularly relevant in this sector. Another advantage here is that in price multiple valuation, if the companies are not similar, we basically throw them away. But this approach allows you to still extract information from all companies because you basically adjust for differences in determinants explicitly so. So two important advantages, but it comes with a lot of structure. So empirically, does it work or not? We know that analysts actually use it. For financial institutions, they use this approach. For insurance companies, for banks, and so on. Many do use this conditional price multiples. Whether they call it this way or not, they use this approach. Does it work? Does it work in the insurance industry? And the answer is a very clear yes. It gives you a significant improvement over book value. Significant improvement over book value. These results are very significant, as you can see. And it actually makes the advantage of book value over earnings consistently high. So clearly works very nicely in this. So this suggests that this approach is relevant. And look, even compared to earnings per share, even compared to forecasted earnings per share, we get improvements here. If you try to extend the model and include additional variables beside ROE, you do get some additional improvement, but not much additional improvement. So I'm going to, the last project I'm going to discuss is the one with Charlie. You can think of it as conditional price multiples too. This is in the banking industry, not the insurance industry. This is essentially the market to book ratio, but instead of regressing the market to book ratio on ROE, we looked at much more detailed information. We basically say, let's look at what banks do. What are the activities? So obviously, traditionally, lending and deposit takings are relevant, but we know that increasingly important are those activities that generate non-interest income, recurring sources of non-interest income, and transitory sources of non-interest income. And we know that characteristics, attributes of the banks also matter for valuation. So we looked at this conditional valuation framework to basically look at the value of banks each quarter. What we were focusing on is what happened to the banking industry during the financial crisis. What we have here is the market to book ratio over time. So going back to about 20 years ago, 17 years ago or so, the market to book ratio used to be about 2, went up to almost 3 before the financial crisis, then crashed to even below 1 at the median, and then started to go up again. So this was the trend for the market to book ratio. Another significant change that we saw in the market to book ratio is that there used to be quite a lot of differences, variation in the cross-section in terms of market to book ratio. This variation, cross-sectional variation, declined quite a lot. And while the market to book ratio is recovered, and it's probably continued almost here now, the variation, the cross-sectional variation didn't go back to the levels that we used to have before. It actually remained very narrow. What caused this? What caused this dramatic and persistent decline in the market to book ratio? What people say is that this is what happened. People say basically that you have the loan portfolio on the balance sheet, it's 60% of the balance sheet, used to be 60% of the balance sheet, significant decline in the value of the loans, significant declines in the value of investments, and these declines in the value of financial instruments are not reflected on the balance sheet. So basically the reason for the decline in the market to book ratio is that the value of the loans and the value of the investment declined, but the book value was not reduced proportionally, so that's why the market to book ratio declined. That's the argument that many people made. We find a very clear answer that this is not the case. This is not the case. What we did here basically, banks are required to disclose the fair value of their loans, investments, and so on. So you can calculate a book value based on fair values. You calculate this and you compare the fair value of the book value to the book value, and they're basically one. This explains, you have to multiply this difference by 30 to get there. So clearly, this is not the reason. The reason for the decline in the market to book ratio was not because loans were overstated on the balance sheet. This was not the reason. So what was the reason? Well, we use this framework to try to answer this question. We use this framework to try to answer this question. What we are capturing here is not just the value of the loans, or not just the value of the core deposits. We are also capturing the intangibles associated with this customer relationship. Because if you have the ability to generate loans on which you generate a relatively high yield and they are not that risky, then you're not creating value just through your existing loans, you're also creating value on an ongoing basis. Similarly with core deposits, if you have these people that put their money in your bank, and it's primarily savings account that you pay very little on, or checking accounts that you possibly pay nothing on, and if you have primarily sticky deposits that are going to stay there, so this is focusing not just for the value of deposits, but also for the value of the intangible associated with deposits. And then more explicitly, we are valuing for any intangibles that are generated through non-interest income, whether related to traditional banking activities like deposits, fees, and so on, or less traditional activities like even investment banking, trading, and so on. And we looked at other attributes that should matter in explaining the market value, the market to book ratio of banks. And then what we did, we decompose the market to book ratio. So this is slightly difficult to see, but this is the median market, this is the average market to book ratio. This is the average market to book ratio. And you can see this big decline to 1, and then starting to grow. Okay? What we have here is as follows. This is the value of lending. This is the value of lending. So the market to book ratio was going up when the value that we associate with lending, primarily the customer relationship, was going down. From this point on, we have a crash in the value of lending, and this is the primary reason that pushes the market to book ratio down. It's not the value of the existing loan. It's the inability to actually create value from this lending relationship. So we have this going down. And then lending starts to improve back, but the market to book ratio doesn't move up that fast. Why? Because the red line is the value associated with deposits. The value associated with deposits actually did decline at the beginning of the financial crisis. It declines much later on, when interest rates went down and stayed basically at 0. If interest rates are close to 0, you're not generating value through core deposits because interest rates are at 0, so having core deposit doesn't give you any benefit. Normally, the value associated with core deposit is being able to obtain these funds, pay very little of them compared to capital markets funds. But if capital markets funds are at 0, then there's not much value associated with deposits. So while loans, the value of lending started to recover, the value of deposit was going in the other direction. And that's what was causing the market to book ratio to remain very low for a significant period of time. Deposits remain low, but the fact that deposits, that lending went up, we saw this recovery. We looked more specifically. So basically our major conclusion was that it's really the decline in the value of intangibles that was pressing the market to book ratio down. There was also the issue of contingent obligations that were not reflected in the books related to litigation, regulatory issues that also caused the market to book ratio to be depressed because the book value did not reflect the contingent obligation. If it did, it would have been pushed down and the market to book value would have been higher. And then there was this effect of regulation. Regulation is much more costly now. Taking on risk becomes much less value creating. So think about all these activities that we can engage in, take on risk, and in the past the price of that risk was not that high. So all the profits that you generated were valued much more than they are in the current environment. Whenever you take on more risk, you're paying for that risk, and you're also restricted in your ability to do so. You have much less leverage, and there is also a mechanical effect for having less leverage that pushes the market to book ratio down. Another interesting result is that we see that dividends, this is a follow-up study that we are working on now, dividends became much more important in this environment for several reasons. One, for example, is that this is basically a mechanism for conveying to us what regulators really think about the banks. Because banks want to pay more dividends, and they don't pay more dividends because they are restricted. And they are restricted by the Federal Reserve that knows much more about the banks than we do because we don't have the same information. So now dividends, the dividends that banks pay today is probably the most important information that we can get. Okay. Charlie, want to add anything about this study?
No, thank you. Excellent job.
Okay, questions for me?